few weeks ago, I did something most people never bother to do. I lined up today's economic numbers next to the numbers that existed just before every major financial collapse of the modern era. Not headlines. Not opinions. Raw data. The oil shock of the 1970s. The early 1990s recession. The global meltdown of 2008. What I saw stopped me cold. Because the similarities are not vague. They're not coincidental. They are precise. The same pressures building in the same places in the same order. Debt climbing faster than the economy can support. Growth losing momentum. Families stretched thinner every month. Property markets beginning to creak. Lending tightening. Central banks boxed in. Unable to raise rates without breaking something. Unable to cut them without fueling inflation. And above it all, asset prices still sitting uncomfortably high, even as the foundations underneath them weaken. We're not in freefall yet. But we are far closer to the edge than most people understand. And that's the most dangerous part. The average person in Britain believes things are hard, but manageable, uncomfortable, but stable. That belief is wrong. Because when you look at the indicators together, not one by one, you see something else entirely. You see multiple warning lights flashing at the same time. And historically, that combination matters. So stay with me. Because by the end of this video, you'll understand which signals line up almost perfectly with past crashes, which ones don't, and most importantly, what specific pressure points would flip today's fragility into a full-blown crisis. That difference matters. Knowing whether we're merely struggling or about to break determines whether people still have time to adjust or whether they get blindsided like millions before them. Economic crashes don't arrive without warning. They follow patterns. They move in stages. And if you know what those stages look like, you can see them forming long before the headlines catch up. I'm going to walk you through 6 indicators that consistently appear before major collapses. For each one, I'll show you what it looked like before previous crashes and where we stand now. Let's start with the first and most reliable signal of all, debt relative to the size of the economy. Every major crash shares this feature. Total debt, household, corporate, and government combined, grows faster than economic output. The gap widens. Borrowing explodes while real productive growth slows. On the surface, things appear fine. Underneath, the system becomes fragile. Before the 1973 crisis, total debt surged from roughly 80% of GDP to over 110% in a short span. Growth was already cooling, but borrowing didn't slow. Before the early 1990s recession, debt pushed past 130% of GDP, driven largely by a property boom built almost entirely on credit. When that borrowing stopped, the economy fell with it. And then there's 2008, the extreme case. Total debt soared beyond 400% of GDP. Banks were leveraged to the brink. Households treated rising house prices like free money. Corporations borrowed at unprecedented levels. When confidence cracked, the entire structure collapsed. That's why this indicator matters. Because when debt outpaces reality for long enough, the system doesn't correct gently. It snaps. And right now, the trajectory is moving in a very familiar direction. For a long time, borrowing in this country has been running far ahead of real economic progress. And today, the scale of it is hard to overstate. Total UK debt now sits at roughly 4.5 times the size of the entire economy. That includes household borrowing close to the size of national output, corporate debt not far behind, government borrowing at historic highs, and a financial sector still carrying enormous leverage. In simple terms, the pile of promises has grown much faster than our ability to actually pay for them. What makes this especially worrying is the timing. The economy itself is barely moving. Growth is crawling along at around 1% a year, while debt keeps rising anyway. That imbalance, weak growth combined with accelerating borrowing, is exactly what we see before past breakdowns. Not a loose resemblance. A direct match. The divergence between debt and output is now larger than it was before the 2008 crisis. That brings us to the second warning sign: pressure inside ordinary households. Before major crashes, families don't suddenly collapse overnight. They get squeezed slowly, quietly, month by month. More of their income goes towards servicing debt. Mortgages, loans, credit cards. Until one small shock is enough to tip them over. We've seen this before. In the run-up to the early 1990s crash, mortgage costs consumed an ever larger share of household income. When interest rates jumped, the system broke almost instantly. Repossessions exploded. Families who looked fine on paper were suddenly insolvent. The same thing happened before 2008, when households borrowed heavily against rising house prices, assuming those prices would never fall. When they did, millions were trapped. Today, household debt is back near those danger levels. Mortgage payments for many people have surged dramatically in just a short period of time. What used to be a manageable slice of income has turned into a heavy burden, almost overnight for anyone refinancing. At the same time, credit card balances are at record highs and defaults on personal loans are climbing. But here's the number that really matters. Millions of households are now spending close to half of their income just to keep a roof over their heads. When that happens, there's no safety margin left. No room for job loss, no room for emergencies, no room for higher rates. One unexpected hit is all it takes. Historically, that's exactly where things become unstable. The pattern here is unmistakable. Household finances are stretched to the limit, just as they were before earlier crashes. The third indicator sits right in front of us, yet many people still struggle to accept it: the housing market itself. Before every major downturn, property prices drift away from reality. Not gradually, dramatically. A simple measure shows this clearly: how many years of average income it takes to buy an average home. When that ratio rises too high, the market stops being supported by earnings and becomes dependent on easy credit. We've crossed that line before. In the late 1980s, house prices reached levels that seemed impossible at the time. When borrowing costs rose, prices fell sharply. The same thing happened before the financial crisis, when affordability stretched further than ever before, only to snap when lending tightened. Today, that disconnect is worse than it has ever been. Nationally, house prices are multiple times higher than average incomes. In some regions, they're far beyond that. This isn't just expensive, it's structurally fragile. At these levels, the system only works if borrowing stays cheap and plentiful forever. And that's the catch. If interest rates stay elevated, or if banks become more cautious, the maths no longer works. The market doesn't gently cool. It adjusts fast and hard. History shows that corrections from these heights are rarely smooth. Once again, the match is strong. Stronger than before previous crashes. Property prices today are more detached from fundamentals than at any point in modern history. And when multiple signals like these line up at the same time, that's when economies stop bending and start breaking. The fourth warning sign shows up when money itself starts to pull back. Before major downturns, credit doesn't vanish overnight. It tightens quietly. Banks become cautious. Rules change. The loan someone could get a few months ago suddenly isn't available anymore. And that shift matters because modern economies run on borrowing. When credit shrinks, it doesn't just slow activity. It creates a chain reaction that feeds on itself. We've seen this pattern clearly. In the run-up to the early 1990s crash, lenders began pulling back on mortgages well before prices fell. They lowered how much they were willing to lend, demanded larger deposits, and reduced income multiples. Demand dried up almost immediately. Without easy credit, the property market collapsed. The same mechanism drove the 2008 crisis. Credit markets seized up before the public fully noticed. Banks stopped trusting one another. Lending froze. Mortgages became scarce. That sudden lack of credit turned a housing slowdown into a full-scale financial crash. Today, we're not at that extreme, but the direction is unmistakable. Mortgage approvals are far lower than they were just a few years ago. Lending standards have tightened. Buyers are being asked for more upfront cash. Borrowing limits have been pulled back. For first-time buyers especially, access to credit is becoming a serious barrier. This isn't yet a total freeze. Banks are still lending. But the contraction is underway, and it's gaining speed. Historically, this phase comes before the sharp decline. The match here is not perfect, but it's strong enough to matter. The fifth indicator sits at the heart of the system: the central bank. Before crashes, monetary authorities often find themselves boxed into impossible choices. They need to fight inflation, which means keeping rates high. At the same time, they need to protect the economy and the financial system from breaking, which usually requires lower rates. When those goals clash, central banks lose control of outcomes. We've seen this trap before. In the early 1990s, interest rates were kept high to protect the currency and contain inflation, even as those rates crushed the housing market and pushed the economy into recession. In the run-up to 2008, rates were held too low for too long, inflating asset bubbles. When inflation finally forced rates higher, the bubbles burst. By the time central banks reacted, the damage was already done. Today, the Bank of England faces the same dilemma. Inflation remains stubborn, forcing rates to stay elevated. But those same rates are putting pressure on mortgages, property values, and heavily indebted sectors. Cut too soon, and inflation could surge again. Hold rates too high for too long, and financial stress intensifies. There's no easy exit. That's the danger. When central banks are trapped between bad options, they rarely manage a soft landing. The historical pattern here is strong. The final indicator is less technical, but often the most telling: the gap between perception and reality. Before crashes, the public mood is strangely calm. People know things aren't great, but they believe the system is stable. The underlying problems are complex, abstract, and easy to ignore, until they aren't. This happened before the financial crisis. Even deep into 2007, most people believed the problems were limited and manageable. A few risky lenders, a few bad loans. Nothing systemic. That false sense of safety delayed action. When the scale of the crisis finally became obvious, confidence collapsed all at once. Today that gap is back. Many people feel stretched, but not alarmed. They see higher bills, not structural risk. They're not looking at the debt burden. They're not watching credit tighten. They're not tracking how fragile the system has become. And history shows that when complacency finally collides with reality, the adjustment is never gentle. Most people aren't seeing any of this. They're not noticing the strain building inside the housing market. They're not grasping how thin household finances have become, and they don't realize how few options policymakers actually have left. That gap between what people believe and how exposed the system really is now uncomfortably wide. Historically, that kind of disconnect is dangerous, but this is the point where it's important to slow down. A crash is not guaranteed. There are real differences between today and past disasters. Some of them could soften the blow. Others might simply delay what's coming. Either way, they matter. The first difference is the banking system itself. In 2008, banks were built on extreme leverage. They borrowed dozens of pounds for every pound of real capital they held. Even small losses wiped them out. That's why the system collapsed so quickly and needed government rescues. Today, banks are in better shape. They're required to hold more capital. Leverage is capped. Stress tests force them to plan for severe downturns. That doesn't make banks immune to trouble, but it does make them sturdier than they were back then. A housing downturn today would hurt, but it wouldn't automatically destroy bank balance sheets overnight. The second difference is savings. Before the last crash, households had very little set aside. When incomes were hit, defaults followed almost immediately. Today savings are higher than they were in the years leading up to 2008. Not as inflated as during the lockdown years, but still above long-term norms. That gives some people a cushion. The problem is where those savings are held. They're concentrated at the top. Higher income households are relatively protected. Lower and middle income families, the ones most exposed to rising housing costs and debt, often have little to fall back on. So while the headline numbers look reassuring, they hide pockets of serious vulnerability. The third difference is the labor market. In previous crashes, unemployment started rising early. Job losses triggered missed payments, which spread stress through the system. Right now, unemployment remains relatively low. On the surface, that looks like strength. But dig deeper and cracks appear. Many jobs are insecure. Part-time work replaces full-time roles. Gig economy positions offer flexibility but little protection. So while employment levels look stable, job security is fragile. That's a different kind of risk, quieter, but still real. The fourth difference is the firepower available to policymakers. In past crises, governments and central banks had room to act aggressively. Interest rates could be slashed. Money could be injected into the system at scale. Those tools didn't fix everything, but they stopped total collapse and bought time for recovery. Today, that room is much smaller. Rates are already well above zero, but not high enough to cut dramatically without limits. Central bank balance sheets are already swollen from previous interventions. Government finances are strained by high debt. If a serious crisis hit now, the ability to respond with overwhelming force would be far more limited than it was in 2008. And that's the uncomfortable reality. The system may be more resilient in some ways, but it also has fewer options if things go wrong. That's not a safety net, it's the opposite. Having fewer tools doesn't prevent a crash, it means that if one starts, it's harder to stop. So when you step back and look at the full picture, Most of the warning signs line up very closely with past crises, even if a few details are different. The next step is understanding how vulnerability turns into an actual collapse. Because weak systems don't fail on their own. They fail when something sets them off. The first and most obvious trigger is a chain reaction in the mortgage market. Here's what that could look like. Over the next year to year and a half, a large wave of households will roll off cheap fixed-rate mortgages and onto much higher rates. Monthly payments for many of them won't rise slightly, they'll jump dramatically. For a portion of those households, the numbers simply won't add up. At first, people cope. They cut spending to the bone. They dip into savings. They rely on credit cards or family help. But those strategies only buy time. After months of pressure, some households run out of options. Payments get missed. Defaults begin. Banks usually try to slow this process. They offer temporary relief, extend loan terms, or allow short breaks. But they can't do that forever. Eventually, properties are repossessed. And when large numbers of homes are forced onto the market in a short period, prices start to fall. Even a modest initial drop can have serious consequences. Recent buyers with small deposits slip into negative equity. Selling becomes impossible without locking in losses they can't afford. Confidence disappears. Potential buyers step back, waiting to see how far prices will fall. Demand dries up. That hesitation pushes prices down further. More households fall underwater. More defaults follow. Banks react by tightening lending even more, pulling mortgages off the table. That reduces demand again. The cycle feeds itself. This kind of housing downturn doesn't need an external shock. It doesn't require a global crisis. All it needs is what's already scheduled: a large number of households being exposed to rates they can't sustain. The key variable isn't whether refinancing happens. It will. The question is how many households break under the pressure. A small number can be absorbed. A large enough share triggers a cascade. The second major trigger sits just behind the scenes: commercial property. Office buildings and retail spaces are still adjusting to permanent changes in how people work and shop. As demand weakens, valuations continue to fall. Large declines turn previously safe loans into risky ones, because the buildings securing those loans are no longer worth what they once were. Property owners facing loan renewals find themselves stuck. Rental income doesn't cover higher interest costs. Refinancing becomes impossible. Defaults rise, banks take losses. On their own, those losses may not bring the system down, but they change behavior. Banks become defensive. Property lending tightens across the board. Commercial loans don't get renewed. Residential mortgages become harder to obtain. Credit to construction and development dries up. At that point, the damage spreads. Builders can't finance projects. Developers can't secure funding. The housing market doesn't get the supply response people expect, because without credit, nothing moves. What looks like a property problem becomes a broader credit problem, and when banks are absorbing losses in one sector, they rarely compensate by being generous elsewhere. Lending contracts across the economy. Investment slows. Growth weakens. That's how stress in one corner of the system turns into something much larger, not through panic but through tightening, caution, and the slow withdrawal of credit. Once credit starts pulling back, the damage doesn't stay contained. Business loans get harder to secure. Consumer credit tightens. Spending slows. Companies respond by cutting costs. Jobs start disappearing. And as unemployment rises, mortgage stress increases again. The pressure feeds back into the housing market, which feeds back into the economy. That's how downturns stop being linear and start becoming self-reinforcing. The risk from commercial property is real. It's already under strain. Whether it tips into a wider crisis depends on how fast values fall and how aggressively banks react. A slow adjustment can be absorbed. A sharp one can't. The third trigger doesn't begin at home at all. It starts somewhere else in the world. A banking shock in the United States. A sovereign debt crisis in Europe. A deeper collapse in China's property sector. A major default in an emerging market. The specific spark isn't the point. What matters is the chain reaction it sets off globally. When fear spreads, investors rush for safety. Risky assets are dumped. Credit spreads blow out. Capital flows toward places seen as safe havens. In that environment, a country like the UK, dependent on foreign capital and running persistent external deficits, becomes vulnerable. The currency takes the hit. A sharp fall in sterling makes imports more expensive almost overnight. Inflation surges again, And suddenly, policymakers face an impossible choice: defend the currency and fight inflation with higher rates, or protect the domestic economy by keeping borrowing costs lower. If rates rise sharply, households on variable mortgages or coming off fixed deals are crushed. Defaults jump, the housing market breaks. A global shock turns into a homegrown crisis. This scenario isn't far-fetched. The global system is already under strain in multiple places. Contagion is a real risk. The fourth trigger is political and often underestimated. Markets don't just react to data. They react to trust. If investors lose confidence in how the UK is being managed, the response can be brutal and fast. An unexpected fiscal announcement, large unfunded promises, sudden tax changes, prolonged political instability. Anything that raises doubts about discipline or continuity can set it off. Bond markets react first, yields spike. Government borrowing costs jump in weeks, not years. That worsens the budget outlook, which scares markets further. Sterling weakens. Inflation pressures return. At that point, the central bank faces another no-win decision: raise rates to restore confidence and risk crashing the housing market, or intervene in bond markets and risk damaging credibility and fueling inflation. We've seen a version of this before. In 2022, markets reacted violently to a loss of fiscal confidence. That episode was stopped only because policy was reversed quickly and decisively. If a future shock couldn't be undone as fast, or if markets didn't believe the fix, the spiral could continue. The odds of this scenario depend heavily on political choices, which are inherently unpredictable. But the precedent exists. And once markets lose trust, regaining it is never quick or painless. That's the reality of where the system stands. Not doomed, but fragile. And in fragile systems, triggers matter far more than people expect. What makes crashes truly dangerous isn't a single blow. It's what happens when several pressures collide and start feeding off one another. That's when systems fail. Let me walk you through how a real-world collapse often unfolds, not in theory, but in sequence. At the beginning, nothing feels dramatic. Mortgage stress starts to creep up as higher rates hit households coming off fixed deals. Missed payments increase. Property prices slip slightly. 5% down from the peak. Uncomfortable, yes, but still easy to dismiss. A few months later, trouble spreads sideways. A large commercial property owner runs into serious difficulty. Office buildings sit half-empty. Loan values no longer match property values. Banks absorb losses and react the only way they know how, by pulling back. Lending rules tighten further. Mortgage approvals drop sharply from levels that were already weak. That tightening matters. Fewer buyers can get financing. Prices slide again. Now homes are 10% off their highs. People who bought recently with small deposits realize they owe more than their homes are worth. Anxiety sets in. Media coverage intensifies. Confidence erodes. Then something external hits. It doesn't have to be local. A financial shock abroad triggers a global flight to safety. Investors pull money out of riskier markets. The pound drops hard. Import prices jump. Inflation reappears just as people hoped it was fading. Policymakers are boxed in. Interest rate cuts that markets were expecting are suddenly off the table. Rates stay higher for longer. Borrowing costs bite deeper. By this point, the damage is no longer theoretical. House prices are down 15%. Defaults accelerate. Banks report meaningful losses. Their share prices fall. Smaller lenders retreat altogether. Credit tightens again. As lending dries up, activity slows, businesses scale back. Layoffs begin. Rising unemployment feeds back into mortgage stress. Forced sales increase. Prices fall further 20%, then more. Transactions freeze as buyers refuse to catch a falling knife. 18 months in, the situation is unmistakable. Prices are down a quarter or more. Large parts of the financial system are under strain. Credit is scarce. The economy is shrinking. Emergency measures dominate headlines. Officials talk openly about stabilization packages and damage control. That's how crashes really happen. Not with one dramatic event, but through a chain reaction where each problem amplifies the next. And here's the critical insight: in the early stages, everything still looks survivable. From month 0 to month 6, it feels like stress, not catastrophe. By the time everyone agrees it's a crisis, it's already too late to move safely. So now you've seen the warning signs. You've seen what's different this time. You've seen the triggers and how they could interact. The final step is deciding what this means for you. This is the framework I use. It starts with 3 simple questions. First, how exposed are you personally? If things break, how hard do they hit you? if you're heavily reliant on property, if you're highly leveraged, if a downturn would leave you with no room to maneuver, your risk isn't abstract, it's immediate. If you're carrying a large mortgage with a small deposit, especially on a variable rate, or one that needs refinancing soon, your exposure is high. Add to that a job in a sector that tends to suffer first in downturns, property, construction, finance, retail, hospitality, and thin savings, and the risk becomes very real. If a modest fall in house prices would push you into negative equity, a serious downturn wouldn't just be uncomfortable. It would be devastating. In that situation, waiting for certainty isn't a strategy. You need to think defensively, even if the odds of a crash aren't guaranteed. Some people sit in the middle. You may have decent equity in your home. Your mortgage is fixed for a while. Your job has some resilience. You've built a modest financial cushion. A crash would still hurt, but it wouldn't wipe you out. If this sounds like you, the goal isn't panic. It's preparation, small adjustments, not radical changes. Then there are those with low exposure. You rent, own your home outright, or have little reliance on UK property. Your income is stable or you're no longer dependent on work. Your savings and investments are spread out. A downturn would still affect you, but it wouldn't threaten your financial survival. In that position, protection matters less, and flexibility matters more. In fact, you may even be in a position to benefit if assets become cheap. The second question is about time. How soon do you need access to your money? If your time horizon is short, the next 1 to 3 years, losses are dangerous even if they're temporary. Maybe retirement is close. Maybe you're building a house deposit. Maybe you have major expenses coming up. In this case, you don't have the luxury of waiting for markets to recover. Stability matters more than upside. A medium time horizon, roughly 3 to 10 years, gives you more room to breathe. You're still working. You don't need immediate access to your savings. You can tolerate some ups and downs, but not a wipeout. This calls for balance, some protection against worst-case scenarios, while staying invested enough to grow over time. A long horizon, 10 years or more, changes the picture completely. If retirement is distant and you don't need your capital soon, volatility becomes less threatening. Severe downturns can be endured, and in some cases, used. If you have cash and patience, crashes often create opportunities rather than disasters. The third question isn't financial. It's psychological. How much uncertainty can you live with? Some people are deeply unsettled by not knowing where they stand. If financial uncertainty causes constant stress, the cost isn't just monetary, it's emotional. In that case, giving up some potential return in exchange for peace of mind is a rational choice. Others can tolerate a reasonable amount of uncertainty, but still want safeguards in place. They don't need perfect safety, but they do need limits on downside risk. That mindset calls for a measured, middle ground approach. And then there are people who live comfortably with large swings, ambiguity, and risk. Volatility doesn't paralyze them. They can stick to a plan even when things look ugly. For them, downturns aren't just survivable, they can be actionable. Once you answer these 3 questions honestly, your exposure, your time horizon, and your tolerance for uncertainty, you have the foundation for deciding what to do next. That's where strategy begins. When you combine those 3 answers, your path becomes much clearer. If you're highly exposed, need your money soon, and don't cope well with uncertainty, you should be prioritizing protection above all else. That means building a serious cash buffer, ideally enough to cover most of a year's essential expenses. If you're facing a mortgage reset in the near future, locking in a fixed rate now may be painful, but uncertainty later could be worse. Where possible, reduce your reliance on UK property and vulnerable assets, and take a hard look at how dependent your income is on sectors that tend to suffer first in downturns. If you sit in the middle, moderate exposure, a medium-term outlook, and a reasonable tolerance for risk, the goal is balance. Build a solid emergency fund. Review your debts and make sure nothing is quietly becoming dangerous. Spread your investments so you're not tied to one market or one outcome. And stay mentally flexible. You don't need to act dramatically, but you do need to be ready. If your exposure is low, your horizon is long, and uncertainty doesn't rattle you, then drastic action isn't necessary. Maintain sensible reserves. Stay diversified, and if a downturn does arrive, be open to opportunity rather than fear. The biggest mistake in this position is abandoning long-term plans because of short-term anxiety. Now, Let's talk about how you'll know whether risk is turning into reality. There are a handful of signals that matter more than everything else, and you don't need to watch them daily. Monthly is enough. Start with mortgage approvals. If lending volumes fall sharply and stay depressed, that tells you demand is breaking down. A brief dip doesn't matter. Sustained weakness does. Next, house prices. Follow one major index consistently. One bad month is noise. Several in a row is a trend. A long, accelerating decline is something else entirely. Watch consumer spending. When retail volumes stop growing and remain negative, it means households are pulling back in ways that affect the entire economy. Pay attention to consumer credit stress. Rising delinquencies are an early warning that financial strain is spreading beneath the surface. Then look at government borrowing costs. If long-term bond yields rise sharply and stay elevated, markets are signaling concern about stability. Track the currency. A sustained fall in sterling isn't just about exchange rates, it's about confidence. And finally, watch bank share prices. When markets price banks far below the value of their assets, they're expecting losses. You don't need all of these flashing red, but if several begin to deteriorate at the same time, that's your cue to shift from watching to acting. So, is a major crash guaranteed? No. Fragile systems can limp along longer than people expect. But are the warning signs unusually aligned? Yes. Debt is high. Households are stretched. Property prices are detached from reality. Credit is tightening. Policymakers have limited room to respond. Public awareness lags the data. And there are multiple believable triggers that could set everything in motion. Once a cascade begins, problems don't cancel each other out. They compound. Your job isn't to predict the exact moment something breaks. It's to understand your own position, watch the right signals, and be ready to adapt. Because the real divide isn't between those who panic and those who ignore risk. It's between those who see trouble forming and those who only realize it once there's no room left to move. Stay alert, stay informed,